All right. Well, good to see everybody. It's November 14th, and it's unbelievable. We're getting so close to the end of the year. It just seems like this year just started, but I'm excited tonight to talk a little bit about what's happening with the portfolios, what's happening with global strategy, what are some of the challenges that we face when we're allocating capital and trying to figure out, where the exposure is. And for those investors in Thailand, Thailand has just been such a tough market for so long. One of the things that I was thinking about when I was looking at my data on the Thai market was at some point, Thailand is going to be a buy again. The last time I looked at Thailand relative to regional peers, Thailand was about neutral. I expect that at some point, Thailand's going to come back, but I'm not sure if I'd position for that right now. But it's something that when everybody's negative or giving up, there's something there that I'm watching. So, Tarinrat, nice to see you. Sawadee krap. And welcome everybody to tonight's discussion. We're going to be talking about the all-weather strategies and the economy and markets and what's going on. One of the things that I'm thinking a lot about right now is what's going to happen in the U.S. election. Next month, about a month from now, I'm going to present some of my thinking on that topic and discuss it. I haven't gotten my thinking clearly together yet. We're still about a year away from the election. So I'm kind of looking at what's going on there and thinking about it. Well, why don't I start off, and I just want to welcome everybody and feel free to ask any questions. That's what makes these calls fantastic. Your questions. Some of your questions are pretty tough too, and I like that. So let's have a discussion. I'm here in beautiful Bangkok in my apartment at Sukhumvit Soi 12. Right behind me, my mother is asleep. She felt sick today, so she's been in bed pretty much all day. But I am ready to talk to you about strategy. So let's start by bringing the strategy report up on the screen. And I'm going to now go through the strategy report a little bit and talk about what I see. Remember to ask questions in the chat. So our strategies are global, they're long-term, and they're diversified. And always remember why we're here. We're here to build wealth over the long term. And as I see it, there's three pillars of investing. Number one, be broadly diversified. Number two is contribute regularly. And number three is stay invested. If you can do these things, you're ahead of probably most other people. I outline a little bit of that in my book, How to Start Building Your Wealth, Investing in the Stock Market, which is available in both book form as well as online course form. Now, our goal is to deliver steady returns over the long run. And here you can see what's been going on with our various strategies. AWS, the red line, launched in February of 2019 and targets a 6% average annual return. AWAF launched in October of 2021 and targets an 8% return. And Inflation Guard launched in July of 2022, targets a 4% average annual return. Those are our goals. Now, from when we started Inflation Guard in July of 2022, the strategies are performing almost as expected. I mean, I would have been happier if they were going up a lot, but markets are tough. So moderate risk AWS has actually had the highest return. It's done well in this environment. And the highest risk, Alpha Focus, ranks lowest. And it can happen when volatility is high. Of course, when the market turns, we should expect to see Alpha Focus, AF, start to rise. And Inflation Guard has the lowest volatility. Now, if we look at the last 12, let's say 16 months or so, we can see that almost all of the strategies are close to 100. Now, since 2022, all strategies, though, are below the world equity, but with lower volatility. You can see the dotted brown line is world equity, which is at 103. So if you were only investing in world equity, you'd be at 103 from starting point of 100. But you would have been riding a much higher amount of volatility. Now, we create our strategies for many decades, but not even a decade is long term. That's me when I was a kid. That's me when I came to Thailand. And that's me when I'm 100. Our aim is to create strategies that perform over many decades. So we're going to go over a performance review of the past 30 days. All weather strategy was up 3.4%. Alpha Focus was up 2%. And Inflation Guard was up 1%. And then we're going to look at some special research, which is 3 times U.S. government debt requires a fight to protect the U.S. dollar. And then I'm going to talk about the global outlook that guides our asset allocation. So first, let's look at all-weather strategy. In the case of all-weather strategy, our main positioning is U.S. developed market and Japan. 85% is in equity right now. And here we can see that since inception, the strategy was up 25.5% and 11.4% above a 60-40 portfolio. And remember, this is after fees. But in the past 30 days, the strategy was up 3.4%, which was 0.1% below the 60-40. The US and developed Europe did the best, and we had a 25% allocation to both. And Japan was worst among our 25% allocations. I remember when we switched into the US, it seemed like it may have been a risky thing to do. But to see that movement into the US has actually, and developed Europe, has actually benefited us is good news. Let's look at Alpha Focus. And here, Alex, I think we have the wrong table here. But since inception, the strategy was down 13.6%. So it's been a tough ride. But it's down about in line with where the 60-40 portfolio was. And it's about in line with world equity, but without as much volatility. We're trying to get rid of some volatility in Alpha Focus. And in the past 30 days, the strategy was up 2%, which was 1.5% below the 60-40. And basically, our defensive tilts, like healthcare as an example, underperformed. So it was tough. And Inflation Guard. Inflation Guard has about 25% in equity and 70% in bonds. Here we can see that since inception, the strategy was up 0.2% after fees and 7.3% above a 40-60 portfolio. And of course, strategy has experienced less volatility. Here we can see in the past 30 days, the strategy was up 1.9%, which was 1.2% below the 40-60, meaning 40% equity, 60% bonds. Gold, money market, and tips dragged on performance as equity rebounded. So these guys were struggling when equity was going up. So that gives a picture of the different strategies and what we're seeing. Remember, if you have any questions, feel free to ask those questions now, and I'm happy to answer them. Welcome to everybody to this call. Hopefully you're relaxing at home. Hopefully you're not sitting at your desk. Hopefully you are relaxing and enjoying, and you have questions. Feel free to ask those questions now. There's so much going on in the world. In fact, one of my biggest concerns right now is, that the U.S. in particular fires off World War III. Waratep asks a question. Let's see. The question is, it seems like interest rate is peaking now. Should we invest in long-term bonds, then move to stocks when the market crashes? I think if you could predict the future and you saw that interest rates are peaking, then definitely buying bonds would be a great opportunity, because when interest rates start going down, the existing bonds see their price going up. So yes, you're right. And longer term bonds have a lot more volatility. So if you're right in that trade, then those longer term bonds are going to perform super well. So yes, that is a trade that makes sense if you think interest rates have peaked. I don't think that's terrible. I mean, I think it's very possible that interest rates have peaked. But it's also possible that interest rates get out of control and inflation gets out of control, or that in particular in America, they have to keep the interest rate high to issue new government bonds, or else there's no buyer for them. And so it's a tough call. Waratep, the other thing that's interesting is that if we go into a recession, as I expect, by the end of this year, by the end of first quarter, what's the Fed going to do? They're going to drop interest rates super fast. And if that was to happen, then your idea of being long, owning long-term government bonds or bonds in general is a great idea. Now, this trade won't work as well with bonds in general, because bonds in general don't swing as wildly as interest rates set by the government, and U.S. Treasury bonds swing. Let's continue on, and I want to talk more about what I'm thinking about. This is some special research I thought I would share. I've been working on it. And what we can see is highest government debt in Japan, Italy, and the US, and corporates are stretched in France and in China. We can see that corporate debt is very high in these countries. And we can also see Thailand's household debt is painfully high. Thailand has the highest household debt, followed by UK and the US in this chart. Now, the US added $16 trillion in debt since foreign holdings peaked at 34% in 2013. Now it's at 23%. The Fed has been a buyer of last resort, though at higher interest rates, more domestic buyers are stepping in. Now, here we can see the Fed's 2008 and 2020 QE shifted the US debt burden from consumers and corporates to the government. In other words, the green area has expanded relative to the other areas. American households are less indebted relative to GDP now compared to around the global financial crisis. Here we can get a picture of Japan. It's the global champion of government debt. Household and corporate debt have been low and steady. And Americans have been asking, if Japan can, why can't we? Why can't we run deficit of the whole economy at 447% of GDP or 261% of GDP for the government? Here's China's total debt to GDP, 297. That's quite massive. And given how China is organized, you can't clearly separate what's government and corporate debt. And so it may be that a portion of the corporate debt is in fact government debt. So adding a portion of the corporate debt to government debt takes China's government portion of debt to GDP about in line with the US's at about 122%. Now, Thai households have levered up over the past 2 decades. Thailand has the 9th highest household debt in the world. Like in the rest of the world, corporate and government debt rose under the COVID situation. And I would argue that this is part of what's causing Thailand to not perform that well from a market perspective, because the consumer just can't buy as much as they used to be able to buy because they're already levered up and have a lot of debt. So where should we expect the U.S. to go from here? A continual rise in government debt, a strong dollar over the midterm, higher interest rates to attract lenders. The Fed continues to be the buyer of last resort to facilitate politicians out of control spending. And over the long term, eventually we'll have a weaker dollar. So let's see what this debt increase looks like. Remember that Japan is currently at 260% of government debt to GDP. Here we can see the U.S. Civil War, where we saw debt to GDP at 33%. World War I, it was at 35%, and World War II, it was at 118. The Clinton era was down as low as 55%. But now, what I've done is I've taken the Japan trajectory of how quickly Japan went up in its debt to GDP, and I laid that out to try to understand when America is going to be facing a huge amount of debt. If the U.S. follows Japan, its government debt is going to be about $88 trillion by 2024. 200% of debt to GDP by 230. That's $46 trillion at that time. Now, it's impossible to imagine in 1988, when I was in university, that government debt per person could rise 9 times. So there's me in university, and government debt per person went up 9 times. And because no politician dares stop government spending, it's just going to keep going up. And now 2.5 times to get to this level. But don't take my word for it. The U.S. government's own forecast is 200% debt to GDP by 2053. My estimate is they hit that by 2030. They're going to be there. So why is this? Well, no politician dares cut Social Security, Medicaid, or Medicare, and they love the war spending. So there's not going to be any cut on Social Security, not on Medicaid, definitely no cuts on war, no cuts on Medicare. And what you're going to see is that the interest is going to continue to rise and become a bigger and bigger chunk of the government spending. So what's the key points? Well, tripling of U.S. government debt requires a fight to protect the dollar. The highest government debt is in Japan, Italy, and the U.S., and corporates are stretched in France and China. The Fed's 2008 and 2020 QE shifted the U.S. debt burden from consumers and corporates to government. China's estimated government debt to GDP is close to the United States, and no U.S. political party dares bring down spending. And finally, midterm, I expect a strong dollar, and long term, I expect a collapse. Now, before I go into the global outlook, feel free to ask any questions that you may have. The key point of this is that the government of the U.S. is just going to continue to borrow and borrow and borrow money, and nothing's going to stop them. The individual taxpayers want the money. Companies want cuts in taxes. Everybody wants to spread out all this money. In fact, America has so much money that they're giving it to Israel. They're giving it to Ukraine. They're giving it to Taiwan. So you may ask, well, Andrew, why is it that we don't see that the U.S. dollar is collapsing? It's because the U.S. government is the fiat currency. And the result of that basically is that they have the power to control the market. You have to use US dollars if you're doing international business. And so that's the first part. The second thing is that the US strategy appears to be create chaos around the world, and therefore the US looks like a safe haven, or it looks like a safe place. And that's what's happening with the dollar. But eventually, I think the dollar will start to really slide. Now, when the dollar starts to devalue, it's going to mean that Thai currency is going to increase. Now, Warren Tepp said household debt increased, but the population also increases. Is it possible the debt per individual remains the same? It probably is by now flat. I haven't looked at the numbers per person, but it probably has gotten to a point where it's flat because banks and institutions are hesitant to give out more. But the point is that at the level that it's at right now, I would also say that the risks for Thailand and the fact that we may not get that much consumer spending is there. And so that's a potential issue. All right. If you've got other questions, make sure to put them in the chat. I think we initially had some problem with the Facebook live, so not sure if our Facebook followers have gotten on, but if you have, welcome. And feel free to ask any question. I'm going to bring my presentation back up on the stage and let me continue on. So let's look at equity. We think that central banks battle inflation while trying to avoid a severe recession or banking crisis. And the recession versus no recession debate continues, and sentiment seems to be in favor of the latter, no recession. A pause in Fed rate hikes could support the stock market. Here we can see the 3-month government bond yield, which has risen to 5.7%. Central banks, as I say, are trying to prevent a recession and a banking crisis, but they're also raising rates to cut inflation. Rates have come up quickly and inflation has come down, so we expect pauses or slower hikes from central banks. Here we can see that now we're in a flat period of time. Of course, this has been one of the biggest and most aggressive rate hikes we've seen. And let's look at the yield curve inversion. Here we can see that all recessions have been predicted by particularly this final point, which we just passed. The average time from inversion until the recession started was about 1 year. So expect the recession to come in about fourth quarter or first quarter of 2024. The market is expecting a continued pause in December. Basically, 86% are predicting that there's going to be a pause. And that could be positive for equity markets. Now, the Fed has succeeded in getting the market to expect higher rates. What we can see is November versus May, they've gone up quite a bit. The market thinks the rate will peak in January of 2024, and no one's bets on more than a 0.5% hike from here on. That's the top of the gray area here, which is the range of forecasts. The market expects the Fed to start easing in June. And here we can see basically that easing is meant to start in June. Most investors think the Fed is done hiking, but that rates will be kept at this level for another 7 months. And falling rates typically have an expansive effect on the economy and vice versa. Let's look at bonds. They're typically a safe place and they bring diversification to the portfolio. In recessions, safer assets like government bonds typically have performed well, though with high inflation, low yields could still lead to negative real returns. And we generally don't allocate to bonds to speculate on the upside, but rather to use them to protect capital. Here we can see that the Global Bonds Master Fund of SCB Global basically are bringing a tremendous amount of diversification benefit because the correlation to world equity is at about 30, maybe 25% now, maybe even down to 20%. And that tells me that the diversification that we have with the SCB Global Fund is good enough to protect our downside. What about commodities? Well, oil price can remain high and food prices have softened. Even if energy stays strong, it may not be worth overweighting commodities. Here we can see oil prices can remain high. While losing some momentum, oil price still has technical support. Saudi Arabian and Russian cuts could keep supply tight. And if demand is sustained, there could be further upside in the oil price. Oil prices driven commodities in 2023. The S&P GSCI index has a 61% weight to energy, while many available commodity funds have less than a 40%. So there's a big energy component. Hence, even if energy stays strong, it may not be worth overweighting commodities. And food prices have softened. As we've seen, there was a spike, but they've been coming down. And if the trend continues down, it would help to lower the pace of inflation. Adverse weather conditions could push up prices again. So commodities rebounded due to oil, but oil is now dragging the index down. The global economic growth outlook remains uncertain, and the main supply in commodities would come from a supply shock, adverse weather conditions, or significantly higher demand due to an improved growth outlook. In other words, what we're expecting is that there's going to be a downturn in the economy, and when that happens, commodity prices are going to fall because demand's falling. What about gold? Well, central banks have been loading up, maybe switching from dollars, and gold protects value in times of uncertainty and market downturns. The gold price trend has yet to turn bullish. Here we can see that central banks have been loading up on gold, maybe switching from US dollars, and the recession risk remains. Gold has basically been flat over this period of time. In general, gold protects value in times of uncertainty and market downturns. Here we can see the gold price trend has yet to turn bullish. In fact, the gold price trend is somewhat bearish right now. And this gives a picture there. So what are the risks? Well, central banks' aggressive rate hikes and QT crashes the stock markets, or continued rate hikes globally could lower bond yields. And if inflation reaccelerates, we could miss out on rising commodity prices. Now, before we get to Q&A, just want to remind you that the Valuation Masterclass Bootcamp number 12 starts on January 8th of 2024. And our limited super early bird price is still available. And with Phenomena, you can save an additional $100. All you have to do is scan the QR code or go to the website and just use Phenomena as your coupon code. All right, it's time for questions. If you've got any questions, now is the time to share those questions. Purple Hippo says, do you think there's going to be a year-end rally? And that is such a difficult question, Purple Hippo. What I would say right now is I'm expecting a recession coming by the end of this year or the end of first quarter. If a recession comes, it would hit the markets probably negatively. However, it's also the case that the Fed could drop rates dramatically. And if they do, then we could see a rally. This is part of the reason why I really like a diversified strategy like all weather as an example, because I'm blending in some different instruments. Of course, I have my opinions of what's going to happen, but the instruments give us an opportunity to invest in many different things. So if I had to choose yes or no, I would say no year-end rally because I'm expecting a recession. But you can't move your positioning out of US too much, because if the Fed was to cut rates, the market would be on fire. That's a lot of words to try to answer that. Sarah Paunan says, hello, John Andrew. I keep learning about investment in English. My goal is saving the money to invest in all-weather strategy. You're doing the right thing, and just keep saving, being careful with your money, and then steadily and slowly contribute and let that money grow. So congratulations to you. That's the key to success for building wealth over time. All right. Do we have any other questions? Feel free to ask any questions, and then we're going to wrap up this session. Hopefully, you got some good ideas or some thoughts about what we're doing. And for those investors that are frustrated that, the markets aren't great, we're on a roller coaster ride, well, I would say that our investment strategies are not on a roller coaster ride, and I am not on a roller coaster ride. And so you can rely on me to be steady and stick to our program no matter what happens. And that's part of the reason why we come here to talk about what we're doing. So that gives a little picture of what's happening with all-weather strategies. When I look at the markets, it's such a difficult time, because I do think that it's very possible that the Fed could cut interest rates back down to zero if the economy or the market or the real estate market or any other place starts to really implode. Well, that's it for tonight's session. Hopefully you've got some good information. I appreciate the questions that you guys have had, and I look forward to seeing you next month, where I'll talk a little bit more about what my expectations are about US elections. Christiana says, is the all-weather strategy a good strategy to earn or to protect? I would say the goal of all-weather strategy is to earn, but also protect the downside. And therefore, we're blending in bonds and gold and commodities to try to reduce the downside. That's a big thing that we're trying to do. Let's see. No nickname says, Fish cut U.S. ratings already. What's the implication? Well, Fitch cut them first, and I expect that Moody's and S&P will eventually cut them. But the implication is nothing, because the U.S. basically has buyers of its bonds from pension funds and the like in America, but also the Fed will buy any of the bonds that the U.S. issues. So yes, it's a bad look, but I would say, it's probably not going to blow out. U.S. credit is not going to blow out, and I think that the U.S. government is going to continue to make its payment. So I don't think that we've got a big issue there. Peachit says, hi, good night. Yes, have a great night. And Maura Tep says, what should we invest in now? Well, of the three strategies that we have, I would probably say at this point, all-weather strategy and a little bit of alpha focus, simply because you just never know when the market's going to turn. Those would be my thoughts for right now. Government short-term debt, November 17th, possible still comp. I'm not exactly government SD. What shutdown? Possible. No, I don't think there's going to be a shutdown, because the Republicans are not going to resist, I think. We'll see. All right. Gory says, like you said, that you're expecting the recession. So what is the indicator that you watch? Indicators such as consumer spending drop dramatically, or property problem, or what else? I think the first thing that I'm looking at is what's happening with employment. Right now, employment is absolutely full, and that's usually a sign that we're basically about to go into a recession. The second thing I'm watching is interest rates. That's the key of what's pushing the recession. So employment, interest rates. I think another big thing that I'm wondering about is corporate profits. If we look at the big 7 tech companies, their profits are amazing. But outside of that, profits are not that strong. If we start to see profits falling off, then that to me would also be some warning sign of a recession. And of course, one of the warning signs of a recession is supposed to be the stock market, because investors are anticipating this. And so in theory, when the stock market starts to fall, that's kind of our ultimate sign. I think that recession, also the property market is definitely, a significant part. I'm not so worried about the home mortgage market because the Fed will buy all the home mortgage loans, but commercial property, I'd say, is an issue. Any other questions? These are tough questions. All right. I think that's it for tonight. I want to thank everybody for participating. Hopefully you gained something on it, but just main thing to remember is stay calm. Don't let the roller coaster ride dictate how you invest. Yeah, thanks, Petch. I appreciate that. Mom has slept all day and she's sleeping right now. She had a little bit of fever last night, but she's going to feel better tomorrow, I'm sure. I'm going to get her out of bed and say, let's have some coffee. Christiana, you're welcome. Great to see you. And to everybody out there, thanks for coming. Thanks for listening. Thanks for your questions. And feel free, of course, always to ask any questions about our strategies. Have a great evening.